Metals. Bill Koutsouras and David Rhodes are going to be speaking. I think one of them is in the Cayman Islands. And how are things in Cayman right now?
Very hot and sunny. I'm sure I won't
Yes.
get any sympathy from your viewers today, Marty.
I think it was about 50 degrees this morning in Boston. So it's getting that time is happening now. And do we have somebody from London speaking as well?
Yes, hi, it's David Rhodes, and it's 30 degrees here and beautiful.
Nice. I really can't see you, so I'm not sure if your video is working or not. Oh, it is working now. Fantastic, great. And my understanding is that Cayman still hasn't opened up. Are people able to travel there right now or not yet?
No, I'm afraid not. It's been a closed border for several months now, and there will start a phased reopening as of the 1st of October. But yeah, quite
the end of October.
Measures. Yeah.
Wow. Well, whatever. So fantastic, guys. Why don't you guys introduce yourselves and talk about what you're doing?
Sure. Yeah, Marty, thanks very much for the opportunity to be here. First of all, we're both very delighted to be here. My name is Bill Koutsouras. I'm one of the managing principals of the asset management division of Endeavour Financial. And Endeavour Financial is an advisory firm that's been around for over 30 years. It specializes specifically in the mining sector and more specifically in the junior mining sector. And by that, we've provided asset management services and financial advisory and technical services over the last 30 years to that particular segment of the mining sector.
And my name is David Rhodes. I'm the joint managing partner with Bill. I've been with Endeavour Financial for over 16 years now, and over 30 years in the mining industry. And Bill and I, myself, are delighted to be here and present the investment proposal to invest in EF Mining Capital Fund.
Thank you, David. Now, I'm hoping my screen is visible to everyone. Marty, I presume you can see the screen that's up at the moment?
It looks good.
Fantastic, okay.
Yeah, thanks.
So as I said, we're very delighted to be here today representing Endeavour Financial to discuss the opportunities in the precious metal sector. I mean, specifically what we plan to discuss today are the market opportunity in gold, and more specifically in gold equities. We do see the most compelling opportunities in this market in gold equities, and we'll dive into detail on what particular segment of that sector we plan to focus on, and really how we intend on tactically capitalizing on the market opportunity in that particular sector with the EF Mining Capital Fund. So with that, I'm going to dive right into it. Market opportunity. So gold is an asset that offers downside protection in this new financial landscape of unprecedented monetary and fiscal policy, low interest rates, currency debasement, and increasing deficit and debt levels. More importantly, gold company investments provide the opportunity for outside returns in this financial landscape. So this financial landscape that I've alluded to is resulting in capital flows starting to move quite significantly into both gold and gold equities. And here's some headlines from the last couple of months. I think one of the most compelling headlines there is seeing a Berkshire Hathaway or Warren Buffett take a $500 million stake in Barrick. As we know, Warren Buffett's a value investor, and he certainly sees the value in investing in gold mining equities given the expanding margins with the rising gold price environment. But additionally, we have the likes of some very macro aware or macro sensitive investors, such as the likes of Paul Singer from Elliott Management, Ray Dalio from Bridgewater, for example, who take that more macro focused approach, who see significant upside potential in both gold and gold equities as we move forward. So what are these macro investors seeing? What is Warren Buffett seeing that's making gold and gold equities a compelling backdrop for making investments? You know, there's a whole confluence of events, but a couple of the more significant ones, negative real interest rates. And the chart here on the top left-hand side of the screen shows the extraordinarily strong correlation between real interest rates being extremely low or negative and gold prices themselves. And we are in an environment where we expect real interest rates to remain either negative or very low based on the rhetoric that we're hearing out of the Federal Reserve Bank in the US. Additionally, when we look around the globe at the sort of sovereign debt around the world, we've got globally $15 trillion and growing of negative yielding debt. This essentially makes gold an attractive diversification alternative to bonds. Gold typically criticized for having an opportunity cost of holding it relative to bonds. So that opportunity cost is disappearing clearly, and there's a diversification benefit to adding gold to your portfolio. So when we look at what's been happening recently in the gold investment landscape, we're seeing a significant amount of investment accumulation. We're seeing the world's central banks continuing to accumulate gold. It's at all-time highs. And additionally, when we look at the exchange-traded funds around the world, we're seeing that from the lows of early 2016, that significant inflows have continued and continue today and have now actually reached all-time highs. So all very supportive of gold prices currently and as we move forward. I suppose less important in the macro factors, but more important in terms of looking at gold companies or gold equity valuations and multiple expansion is looking at the actual gold fundamentals themselves. And one of the dynamics we see there is that gold company reserves are down 40% since 2011. And for those of you that are somewhat aware and follow gold prices, you'll recognize that gold prices dropped quite significantly from late 2011, early 2012 onwards. That resulted in a significant lack of investment into reserve expansion, exploration, and project development. And as a result, we have the situation with declining gold reserves at the senior gold mining companies, additionally reaching peak production levels. So what do we expect to happen from here? We expect there to be a significant increase in M&A activity as we move forward, for the purpose of replenishing these depleting reserves on the balance sheets of the gold mining companies. In particular, we expect that to be far more pronounced in the junior mining sector, given the junior miners are really the lifeblood of the mining sector. They're the ones that have the next generation or pipeline or projects, if you will, that will be required in order to sustain production levels and increase reserves. So consequently, our investment strategy here to capitalize on this enormous market opportunity is to focus specifically on the junior gold mining companies. In terms of project stage, we are focusing primarily on companies that have near-term production potential, the top geographic jurisdictions around the world, such as the US, Canada, the top mining jurisdictions in Latin America, Western Europe, Australia. We're focusing on negotiated private placements directly into these companies with the use of proceeds to develop their assets into production, and taking a very active approach with these companies, really a merchant banking investment approach, if you will, where we have board representation, technical committee representation, and dilution rights, and targeting a base case IRR based on conservative gold prices of 30% plus.
Hey, Bill, can you just talk a little about the types of companies that you're investing in? Like, what's their typical size? You know, and also maybe you can talk about the state of mining technology, because my understanding is that, you know, the fracking revolution that happened with oil and natural gas has happened in mining as well for precious metals. And so it'd be great if you can just get some perspective on that.
Sure. I mean, I think to be honest, there is some technological advancements in the mining space, but nothing to the extent of the aha moment that the oil and gas space saw with fracking. We're having some artificial intelligence and machine learning that's being used in order to generate targets for further exploration and drilling, for example. We have autonomous trucks that are working to reduce injury times and improve the efficiency of mining. But when it comes to drilling techniques and sort of making discoveries, you know, that process is actually getting harder and harder, in fact. And we're not seeing that same level of ability to extract ore at sort of less or reduced prices, if you will. So mining is definitely significantly behind the oil and gas sector when it comes to technology, but they're slowly catching up.
And let me ask you a question, is there an impact aspect to any of this? I mean, I know that there's been lots of complaints about things like strip mining in Peru and things like that.
There's absolutely an impact aspect to this. That's an excellent question. We have an extraordinarily keen focus on ESG when it comes to mining. It is one of those sectors where focusing on ESG actually is an enormous value driver. The reason for that is, well, we're focusing on companies that are construction ready. They have environmental impact assessments that are already in place. And so we could actually evaluate if there's any environmental issues or matters that are of significance to us that we need to be concerned about. We certainly want to invest in companies that do. And additionally, there's social impact assessments that are done, ensuring that there is no social unrest potential, that the communities that surround the mine that's going to be developed are actually going to be supported by the communities. And so effectively, that's what we call in this business a social license to operate. So those are key aspects that we consider before making an investment in any particular company. Is the environmental side covered? Is there a social license to operate? And the benefits of that is certainly that as you work through mine development and operations, the possibility for disruptions on the social side are significantly reduced. And so we find an enormous amount of value by having a keen focus of our due diligence on those particular areas. And I mentioned junior miners, they do outperform in a gold bull market, and I'll answer the second or first part of Marty's question as part of this as well in terms of the types of companies we're investing in. These companies we're investing in are typically either traded on the Toronto Stock Exchange, the TSX Venture Exchange, or the Australian Stock Exchange. They are junior mining companies that would have market caps ranging from 100 million upwards to $300 million. They are development stage mining companies that need that last influx of equity capital alongside project financing that's being put in place in order to move their projects into production. And so when we sort of look at the universe of opportunities in the junior mining sector, we look at the TSX Venture Exchange Index. It's not a perfect barometer, but it's probably the best one out there globally. The reason for that is greater than 50% of the listed issuers on this exchange are mining issuers. That includes explorers, developers, and producers. So it's certainly not a perfect barometer, but one of the best ones out there. And if we look at the two previous gold bull markets that took place, we see that the actual returns were over 3x. That's looking at the period from 02 to 07 and from 08 to 2011. And when we look at where we are at today in terms of valuations of the actual index and the market itself, we're seeing that we're just starting to recover off of historical lows. And I think importantly worth pointing out is that there is no ETF that's linked to this particular segment of the mining space, development stage mining companies. And if one wanted to undertake doing due diligence and making investments in the sector, you're looking at potentially a universe of over 2,000 companies globally. So it is an area where having industry relationships and that industry expertise are absolutely critical to making strategic investments and generating alpha.
What's the time frame for return on investment?
The time frame, we're looking at a 1 to 3 year exit period on all these investments, Marty. And the reason there's at the short end, we have typically in some circumstances, as these companies are moving through the development process, there will be an M&A exit event. And that's due to the fundamentals that I went through earlier, that there are mining companies that are looking to replace depleting reserves. On the longer end, we're looking at moving the companies and building value as they expand into production, and potentially looking at an exit event once they actually enter production, either through an M&A type event or effectively selling our stake to strategic buyers or liquidating it in the markets, given these companies are all publicly traded that we're focusing on.
In most cases, gold is a inflation hedge. Is that correct?
It is absolutely an inflation hedge, but it's also, in the current landscape that we're in, a deflation hedge as well. Sort of,
Come again? Can you explain that?
Yeah, I mean, when we think of inflation, I think everyone kind of understands that the hedge of gold is the debasement of currencies, if you will, and gold providing that hedge. When we think of the world that we're in today with, extraordinarily high debt levels, both at the corporate and sovereign level, a potential deflationary scenario which the Fed is trying to avoid does give you this debt deflation potential, which is effectively a very bad outcome for the world economy and bond markets around the world. So in that sort of environment, fear will take over and gold will continue to be a very strong performer. So if you will, the boogeyman for gold potentially as we move forward here is very high real growth rates and real inflation rates ticking higher for the foreseeable future. And that's something that we certainly don't see, at least looking out for the next 2 to 3 years.
Okay, because I think a lot of people are looking at an inflationary perspective since the world is printing money.
That's certainly our base case scenario. We expect that, and there's certainly some of the sort of large and respected investment banks out there like Bank of America and UBS that on the back of that inflation and money printing predict prices going to 3,000 or higher. We like to be conservative in our approach. We like to value gold companies based on lower prices than where they're at today, around $1,500 or $1,600, And we'll make the assumption for our upside case that gold prices remain supported here and don't actually move higher. We'll have some blue sky scenarios with prices moving up to higher levels, but certainly our investment thesis here isn't based on gold moving higher. It's based on building value in these gold companies through mine development and startup.
And so you're making money by the increase in the valuation of the company or by the income of the company or revenue?
Initially, we're making value by the increase in value of the company as they move up the development curve. And there's I'll just quickly, if I may, jump to this particular slide here. And this is the life cycle of a sort of junior single asset development stage mining company. And we work with the companies really at the stage where their feasibility studies are being completed and they're construction ready. And what you'll see in this development curve here is at the far left, you have exploration stage where these companies are undertaking high risk, binary outcomes of looking for an ore body. That's very speculative. We're not focused there. We're focusing on this gray shaded area in here. After a mining mineral discovery has been made, engineering studies have been done, cost of what it's going to cost to build the mine have been done, feasibility and engineering studies have been done to understand the operating costs. Effectively, the project is bankable. And as you move from mine development into startup, you move up this valuation curve. And so you have multiple expansion. Our primary metric for evaluating companies is price to NAV. And as you move from this area up to here and into becoming an operating company, you're typically going to a price to NAV of around 1.0 as a company. So what we're focusing on is, can we make a 30% IRR through this value add de-risking of mine development? If gold prices move higher, that's significant upside potential, if you will. If there's an acquisition, that's an additional premium on top of our base case thesis.